Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Hey everybody, this is our 8th episode, and today we're going to revisit an example from episode 6 to illustrate how changes to the income statement filter through to the balance sheet and to the statement of cash flows. And as a refresher, we're walking through an example where you're getting paid $100,000 up front for work that you are contractually obligated to complete over the next 2 years. And the main two things that I want to highlight here are, one, we're going to be talking about each of the 3 statements at 3 different points in time. So pay attention to how each of the statements change over time. And 2, for the first time, we're going to introduce the concept of taxes. This is a hugely impactful component of any of these 3 statement modeling analyses, and I guarantee will factor into interviews, technical interviews that you might have in the future. So in this example, we're going to show the impact of an assumed 20% tax rate on our financials. That's just an illustrative assumption that we're going to use for round numbers, but it's, not inconceivable that that's the type of tax rate you might be dealing with. Lastly, this is the most number-heavy example we've had thus far, so this episode requires a bit more active listening than most. And I would also recommend having a pen and paper handy to keep track of some of the numbers to ensure that you're able to follow along.
So I know that from what we've talked about, the cash flow is just how much cash you're bringing in over like a given period of time. But I kind of just wanted to go over again, like how cash flow is comprised of the income statement and how like you would calculate that, if that makes sense.
Okay. Yeah, it's a great question. So let's start with this same hypothetical example. So it's $100,000 that you're going to earn for 2 years of work, but they're paying you the money up front.
Okay.
I want to know what our year 1 cash flow looks like.
Well, I think I would probably have to take in that income, that being 50,000, but then as we like kind of mentioned before, I think I would also have to include like taxes and how much like that deducts from our income.
Yep, exactly. Yeah. So we got $50,000 and I've been calling the $50,000 income, but you're right, really it's revenue.
Okay.
Or like, salary or sales or like whatever you want to call it, but really it's $50,000 in revenue. For this simple example, we're saying we have no costs associated with that revenue. So our profit before tax is $50,000. Let's say we pay 20% tax on those $50,000. And so that's $10,000 of tax. So we have $40,000 of net income in our first year. Now we have to go to our cash flow statement. And by the way, we talked about our balance sheet on day 0, and we talked about our balance sheet at the end of year 2. What does our balance sheet look like at the end of year 1?
Wouldn't our balance sheet be somewhat similar to our, revenue that we're bringing in the sense that it would be like 50,000 before the taxes were applied?
So it's we now our cash balance, we said, and by the way, so like in the last example, we said that our day 0 balance sheet looked like $100 of cash and $100 of like work we owe, and then equity of 0. And we said at the end of year 2, it was still 100 of cash and 0 of work, so 100 of equity. That hypothetical ignored tax actually is now we're getting into. So now at the end of year 1, what does our cash look like?
Wouldn't our cash be 50,000 or?
Well, our cash was 100.
Okay.
Did we do anything? Do we have to pay any cash for any reason in that first year?
No, unless we like reported that. Like
let's say we just reported it and we owe taxes.
Okay, well then we would have to like subtract from the 100,000 how much taxes we owe.
Yep. So let's say that we now have 90 in cash because we reported 50,000 of it. We did all that income statement math to say we owe 10,000 in taxes. So our cash is 90. What about our liabilities? What do we still owe in work?
Wouldn't we technically owe $100,000 in work since it's like for the next year?
Is it even if we did a year of work already?
I believe so, because we still like our contract is that we have to do 2 years, but I might not be.
So yeah, well, this gets into the averaging it out thing. And so I think like what a lot of people would try to argue is we signed up to get $100,000 for 2 years of work. So on day 0, we owe $100,000 worth of work. Like we haven't accrued any equity yet. But at the end of the first year, we've performed half the work. So our liability is half what it was when we started.
Okay.
So what would that make our liabilities?
50,000.
Yeah. So we owe $50,000 worth of work. So now we have 90,000 in cash, 50,000 in liabilities. So what is our equity?
Wouldn't it be 40,000?
Yep. That's the remaining amount. And the way, if you're like creating the math formulas for this, one thing that some people do but is wrong is they'll just say like our equity is equal to the difference, because then it'll always balance. But the right way to do it is to set your retained, they call this retained earnings, is to basically say your retained earnings is whatever your retained earnings was last year.
Okay.
Which was 0 because we had 0 of equity, plus your net income, which is 40. So you brought in 40 of net income. So we have 40 of equity. We said we owe 50,000 of work. So that's 50,000 of liabilities. 40 plus 50 is 90. Okay. And that equals our cash balance, and everybody's happy in the world. Because 90 equals 90. So now we know our income statement. We know our balance sheet. And by the way, this is like a lot of mental math that I know you're doing. So you're doing really well. And I'm trying to keep up too. So then let's talk about our cash flow statement. Okay. How much cash did we bring in year 1?
In year 1, didn't we bring in 50,000?
40,000? Those are possible answers, but okay. What did we get paid in cash during the first year?
100,000 since we chose to.
Yep. And what did we pay in cash in the first year?
10,000, I believe.
Yeah. So what was our cash flow for the first year?
90,000.
Yeah. So this gets into why all these 3 statements matter. Is it's like different. It's like very different numbers, right? Like $40,000 in net income, but $90,000 in cash flow. Like very different numbers. And there are 2 methods. There's the direct method and the indirect method that people have for trying to figure out what your cash flow is. Okay. What you did is I'll call that the direct method, which is like we just like tallied up how much did we have coming in and how much did we have going out. The indirect method is actually a lot more common, which is we start with our net income, okay, which is 40,000, and then you could say, what was there any change in cash that is not reflected on the income statement? And the answer is yes, because we have this liability where we owe this work, but we already have the cash for it. Okay. And so I would add that in. Okay. Is basically the way people would think about it. So our year 1 cash flow is 90,000. But we needed to know how much tax we owe to calculate that 90,000, right? Okay. Yes. So now let's talk about our cash flow in the second year. Or tell me about the income statement, the balance sheet, and the cash flow in the second year.
Well, if I'm like saying this correctly, wouldn't our cash flow in the second year, I believe it would
Let's
not.
let's start with the income statement, because like
Okay.
that, like my bet to you is you can't tell me about the cash flow statement until you tell me about how much taxes we owe.
Okay.
And you can't tell me about the taxes till we do the income statement. So
Okay.
let's always start with the income statement.
Okay. So then wouldn't our income statement again be 50,000?
Yes, but then what's our net income after tax?
40,000?
Yep. So income statement looks the same in year one and year two.
Okay.
That's accrual accounting and the averaging out that we were talking about. Yeah. So it's the same in each year because you're doing the same work under the same contract.
Okay.
So now let's talk about our balance sheet at the end of year two.
Okay.
Which we already talked about before, but we didn't include tax before. So let's include tax now.
Okay. So if we were including tax, which is $10,000 again, like in year one, wouldn't our balance sheet be 80,000 or I don't.
Yep.
Okay.
That's it. Yep, exactly. You started with $100,000 of cash in the bank. You paid $10,000 of taxes in year one, 10,000 in year two,
Yes.
80,000 cash in the bank at the end of year two. Yep.
Okay.
And let's say it's like a more complicated scenario where we like didn't know it was like exactly a 2-year contract and like stuff was different. The way that people always think about doing like balance sheet numbers is basically they'll start with what was true last year,
Okay.
and then they'll add the effect of what's true this year.
Okay.
But yeah, so but that's exactly right. So 80,000 in cash. Any liabilities?
No.
Okay. So any equity?
Wouldn't you have the $80,000 in equity?
And do you remember what the line item we call that is? Do you remember the name?
I do not.
Retained earnings.
Okay, retained earnings.
So how did our retained earnings change from day 0 to the end of year 1 to the end of year 2?
Well, at the end of year 1, our retained earnings, like day 0, weren't our retained earnings just $0?
Yep.
And then at the end of year 1, our retained earnings would be technically $90,000, or is that no? It would be 40,000.
Yep.
And then at the end of year 2, 80,000.
Yep. And
okay.
So our retained earnings went from 0 to 40 to 80. Our net income during the first year was 40. So 0 plus 40 equals 40. And then our net income was also 40 in year 2, 40 plus 40 to 80.
Okay.
Exactly. And our balance sheet is balanced in every period. The number has changed, right? We went from like 100 to 100 to 90, 90 to 80, 80. But all we care about is that it balances.
Okay.
And so now let's talk about our cash flow in year 2.
Okay.
Tell me about our cash flow in year 2.
Well, considering what we've talked about, in our cash flow in year 1 was 40,000, correct?
Our cash flow was more than 40.
90,000.
Yep.
Okay. So our cash flow in year 1 was 90,000. So then wouldn't our cash flow in year 2 be 90,000 as well? Or is that incorrect?
Well, tell me about that. So, what actual cash did we have coming in the door in year 2? Who paid us?
Not have any actual cash in year 2?
Yeah, none.
Got it all from zero. Okay.
Yeah. Did we have any cash going out of the door in year 2?
Didn't we have 10,000 because of taxes?
Yep, exactly. So what is our and let's do it the same way we were doing it before. So this is like the direct method, which I think is a fine way to learn this stuff. So let's just do that. So our what is our free cash flow then for year 2?
Wouldn't it technically be 0 since we're not like bringing in over that time period?
It's even worse than 0.
It's negative. because we're paying 10,000, but we're
Yeah.
not bringing in anything.
Yeah.
Okay.
So what is it?
Negative 10,000.
Yeah. And so, by the way, like let's step back now. So and think about this holistically and think about if all the numbers like mix and match. So
Okay.
what was our net income in year one?
40,000.
Net income in year two?
40,000.
What is our total net income over the 2 years?
80,000.
Yep. And what is our cash flow in year one?
90,000, we said?
And yep.
Yes.
And what is our cash flow in year two?
Negative 10,000.
So what's our cash flow over the 2 years?
80,000?
Yeah.
Or no? Okay.
Yeah. And how does the net income compare to the cash flow over those 2 years?
Wouldn't it be equal?
Yeah, they're both 80,000, which is
Yeah.
exactly what we want.
Okay.
Like the goal of all of this is not to do like magic where like somehow over the long run the cash flow is different from the income statement.
Okay.
It's more that because we're in the income statement, we're doing this averaging out stuff. The goal of the cash flow statement is to be like, okay, you did this averaging out stuff and you paid some taxes based on that. But like, let's set all that aside and just tell me about the cash flow. Coming up, we're going to continue talking about how the three statements work together, but keep in mind that ultimately what we're gearing up to really talk about are projections and valuation. So I want you to leave this episode thinking about two questions. One, which metric of all the things we've discussed is the most important outcome metric? And two, if we were trying to project performance in year 2 or year 3 or beyond at the end of year 1, which metric is most likely to have good predictive power for future performance? And as a hint, the answers to those two questions that I just posed are different. So I will leave that there and we'll pick this up again next time. That does it for today's episode. Thank you so much for listening. And remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.